Hey everyone, welcome to the session. I am Sunil Bhatia and this is a video presented by Risk and Compliance Professionals Association. In the wake of recent coronavirus outbreak, officially named as COVID-19, has brought the world to a grinding halt. Governments across the world have ordered the people to immediately adopt social distancing to stay away from workplaces. Education institutions, businesses, and travel have been asked to shut down, all in order to contain this contagion. Now, this in turn has further resulted to a lockdown of cities and have severely affected economies across the world, adversely impacting the economic activities, income of the firms and individuals, and valuations of almost all asset classes. IMF has officially declared the world is in recession. In this presentation, we will try to understand how to manage credit risk at financial institutions due to COVID-19's pandemic downturn. The COVID-19 coronavirus pandemic has caused a sudden rapid decline in economic activity in recent weeks. Economic lockdown is not confined only to India. At present, more than two-thirds of humanity is under economic lockdown. This scale is unprecedented in the human history. So regulators and governments have taken special measures across globe to bring back the financial stability in the environment of uncertainty and to prevent economy falling into the downward spiral of recession. Governor of RBI has commented to quote unquote, "This kind of uncertainty towards the growth outlook has never ever happened before. This is unprecedented." Bank of England in its agent report has described the situation as being worse than the financial crisis in 2008. All-round ability of borrower to repay is adversely impacted at an unprecedented scale, and hopefully the impact is temporary. To tide over the impact, governments across the globe have provided moratorium on declaring customer as default for non-payment or breach of covenants. During the last week, Federal Reserve, Bank of England and RBI made such announcement. More announcements are expected. Experts have started predicting that economic impact may not be temporary, may last few quarters to few years, thus completely changing the process, systems and models for credit risk measurement, loss estimation and stress testing. Governments across the globe have adopted social distancing as a primary measure to control the spread of pandemic. Therefore have locked down their cities to control the contagion of virus. The idea is to slow down the spread and growth in infected cases to a level which can be managed by the healthcare system in the country. But this also means that, as you can see in the diagram on the left, that containment process will be elongated, necessitating the lockdown of the economic activity for a longer time. With the global lockdown, more than 30% of economic activity overall at the global level and up to 60% of economic activity nationally is halted. We have no data or information to predict lifting of a lockdown or economic recovery path. Halt in the economic activity ultimately breaks down the supply chain. The most important impact of lockdown is the loss of income and unemployment. Businesses are incurring losses due to operational leverage and financial leverages. To reduce the losses, businesses are winding down their capacities and may default on the debt, further accentuating the supply, demand and employment conditions. So the economists are busy discussing the recovery path. They are agreeing that every industry may not traverse the same path. Considering the scale of the damage, industry will go through W, U and L path. For certain industries, rebound might happen immediately after lockdowns are lifted up. But industries consuming their output may not bounce back at the same rate, or all their input industries may not bounce back, creating W recovery path. For others, the recovery path may be prolonged, running into quarters and years, following U shape, and some industries may not recover at all. To provide relief to the firms, regulators and governments have proposed a moratorium on payments to financial institutions, downgrading to default, insolvency process, payments of taxes and utility bills. In the next two slides, let us discuss moratorium imposed against financial institutions by the central banks. We have generalized the instructions. For better accuracy, please refer to the circulars of your regulator. Common practice for loss computation suggests to rely on probability of default, PD, loss given default LGD, and exposure at default EAD as your input parameters. Banks estimate the ECL, expected credit losses, as the present value of those three parameters, product over 1 year or lifetime horizon. Based on this, a distinction arises between CECL and IFRS 9. CECL follows a lifetime perspective for all credits. IFRS 9 classifies accounts in three main buckets: Stage 1, that is 1 year ECL, Stage 2, that is lifetime ECL, and Stage 3, that are impaired credits. The key innovation introduced by the new accounting standards subsumes a shift towards a forward-looking and lifetime perspective. Therefore, a link between macroeconomic variables, behavioral variables, and PD, LGD, and EAD is crucial for this exercise. This framework is also a natural candidate for stress testing projections. Moody's has recently estimated that the probability of default has increased by 80% for US corporates and large firms. To come up with these parameters, we need 1. Forecast modeling on economic conditions, and 2. Historical data and current state conditions. In the wake of coronavirus, it might be difficult to correctly identify the forecast of economic conditions, resulting in a large chunk of portfolio losses moving to further stages. To avoid this more downward push amidst the uncertainty, regulators have prescribed payment holidays within which borrower profiles will not be moved to further days past due or DPDs. Now, talking about providing moratorium on downgrading of loans for non-payments of installment due. 1. Computation of credit losses is difficult under present scenario. There are no historical data points. Without the moratorium, financial institutions is likely to take conservative view, further reducing the funding, liquidity, and capital of firms, accentuating the economic scenario further. To halt this, regulators have mandated moratorium. Ultimately, it will help the bank's economy to rebound, and many of the banks may not be able to survive the credit losses if recognized immediately. Point 2. Considering the government and central banking policy on payment holidays, loans with overdue payments should not be moved to Stage 2 or Stage 3 for computation of credit losses. Now let's talk about moratorium on downgrading a loan for breach of covenants. Pandemic has broken down the supply chain and locked down manpower. Under the existing scenario, firms may not be able to comply with financial and other covenants due to internal and external dependency. To prevent the financial institution from downgrading firms on technical ground, further accentuating the economic activity scenario, regulators have imposed moratorium on downgrading customers. Regulators have attempted to prescribe applicability on moratorium requirements as sharply as possible. Time period for payment deferrals, fee waivers, extension of repayment terms, or other delays in payments varies across the jurisdiction. For the time being, this period is 3 months in most jurisdictions. In India, for all outstanding loans as on 1st March, all payments falling due from 1st March to 31st May are covered. So for example, if payment was due from 2nd March 2020, its due date would be revised to 2nd June 2020. Dues could be credit card dues, principal repayment, interest payment, EMIs, or bullet payment. It means payment will not be considered as past due till that date. However, according to the existing regulatory instructions, payment past due on or before 29th February 2020 will not attract this benefit, and days will accrue if payment remain outstanding. Increasing DPD will be considered. Please note that interest will accrue during the payment holiday against the borrower. Banks will also realize the interest accrued during the period in their income. As part of credit governance and best practice, financial institutions should also identify weakening in the creditworthiness of borrower otherwise than due to the pandemic. For example, fire, trading losses, and loss of key personnel, etc., and take appropriate actions. Some banks may also internally measure losses without considering moratorium to understand the reduction in available capital and consumption of capital buffer. All industries and borrower types and collateral types will not be impacted uniformly. the financial institutions who can predict the impact more accurately, early, and takes action emerge as a stronger and better. Experts have predicted that credit risk management process will change substantially. Moratorium is only for customer, regulatory reporting and credit bureau reporting. Internal models, processes, and systems of the bank should continuously upgraded to consider the impact of changes in economic activity of customer, industry, and country. Credit scoring and rating models need to be recalibrated considering the impact of U and L curve on the scale of income, valuation, and accounting ratios and financials. Accounting ratio and collateral valuation driven governance needs to be recalibrated. Valuation of collateral and release of limits needs to be recalibrated considering new working of capital cycle. Collection models need to exclude payments covered by moratorium, creating complexity and customer dissatisfaction for a customer with non-excluded overdues. Stress testing and ICAP scenarios need to be expanded to include additional severe scenarios. Regulatory reports will reflect higher capital, higher income, better liquidity, and lower credit losses for the period. Regulator may ask for reports on the impact for better framing of policies. Forward-looking assumptions on losses have already started evolving, and this will further get refined in the days to come. Banks need to upgrade technology to support the changing credit risk management process as it evolves. Core banking solutions to identify day past due loan. All credit scoring and rating models need to be recalibrated considering different scale for income, demand, and accounting ratios. Stress testing and ICAP will include new scenario for severe stress events. Additional information may be asked product-wise on exposure and losses under moratorium. Collateral valuation and allocation approach may need to be recalibrated. EWS for financial covenants needs to be changed. In India, economic lockdown is still in its early days. However, we can look at the data available from China and United States. For India, HDFC Bank has predicted in its treasury report that 21-day countrywide lockdown will shave off 74% of monthly real GDP or rupees 10 lakh crore in first half of 2020. Recently, China has released year-on-year change measures for 5 economic activity indicators for the Jan-Feb 2020 when pandemic was at its peak. The data show during the 2 months of lockdown, economic activity has depreciated between 13 to 25%. On 26th March 2020, a record 3.3 million people filed claims for unemployment in the United States last week as the COVID-19 pandemic shut down large parts of America's economy, being one of the strongest indicators for an economic crisis. Due to high rates of unemployment and depreciating economic activity, cash inflows get severely impacted. S&P and Moody's have downgraded the securitized assets severely in the past 2 weeks. S&P Global quotes, the COVID-19 pandemic has likely pushed the global economy into recession and could cause a surge of defaults among non-financial corporate borrowers. COVID-19 will adversely impact income, leverage, capital, and liquidity. Therefore, high quality of credit risk governance at banks is required during the next few years. FIs need to clearly understand the impact of economic indicators on borrowers and in turn impact on the FIs. This understanding will help establishing a best practice governance framework for credit risk management. The impact on customers will be due to disruption in the supply chain, the industry shape, and the curves may change permanently, impacting the financials of borrower. This will impact FIs in terms of regulators have mandated no additional charge for payment deferrals, fee waivers, extension of repayment terms or other delays. This waiver will severely impact income, liquidity and capital of lender. Transition beyond the waiver need to be planned and managed carefully. Operational and financial leverage and income of the borrower will get adversely impacted. It may take months and years to restore the pre-crisis measures. Borrower need to induct additional capital. Some of the firms may go bankrupt. This will impact FIs in terms of no interest penalty or recovery or liquidation of collaterals, severely impacting asset quality. Moratorium will provide temporary relief or protection from penalty or restriction on the account, reporting to the credit bureau during the moratorium period, and downgrade of credit rating. FIs will get impacted due to no interest or installment received, adversely impacting the liquidity and ALM position of the bank. The bank may recalculate the drawing power by reducing margin or by reassessing the working capital cycle. This will impact FI in terms of default is not yet recognized, income recognized in the books, inflating the income statement of the bank. Unless the regulator provides smooth and longer transition, customer get penalized once moratorium is withdrawn, and if the account is not regularized within the given transition period. This will impact FI in terms of maturity bucket reclassification of installments due, adversely impacting short-term cash flow of the bank. Some additional statements by regulators in past few days. Value at risk backtesting exceptions temporary approach. There is exceptional levels of market volatility over the past few weeks, and this has to be an elevated level of VAR backtesting breaches across industry. In order to mitigate the possibility of pro-cyclical market risk capital requirements through the automatic applications of a higher VAR multiplier, the PRA will allow firms on a temporary basis to offset increase due to new exceptions through a commensurate reduction in risk not in VAR capital requirements, and exposure value for internal models method for counterparty credit risk. Some firms have recently experienced significant moves in counterparty credit risk-weighted assets, and PRA has suggested that these moves are partially attributable to large margin calls following significant intraday market price movements. UK banks have agreed to scrap £8 billion dividends amid recession fears. The Bank of England has also ordered lenders to cancel plans for cash bonuses for executives, as it asks financial institutions to boost their strength ahead of a likely recession. Thanks for watching. This is with the compliments from Risk and Compliance Professional Association, a Section 8 not-for-profit company in Mumbai. For more details, webinar, sessions or online training, please contact at info@rcpa.in. To learn more, visit us at www.rcpa.in.